Well, greetings. Today, what we're going to do is we're going to have a very quick discussion where we're going to go through all of the essential terms when it comes to the M&A side of deals. Now, I realized that I've done a series on Explain the Concept, which talks about essential terms, and I hadn't really done anything on the M&A side, partly because when I really got started with the work that I was doing, I didn't realize just how much I was going to focus on exit planning. However, what I realized is, this is some content that needs to be addressed, but more importantly, what we need to do is we need to have instead of having individual videos on every single term, what would be a little bit more helpful and concise would be actually have a webinar where we just ran down all the terms. Because if you're going to be working with me, thinking about working with me, or you're getting ready to exit your business, or just being introduced to this topic, the reality is all the terms that we're going to be discussing here today are going to be terms that are going to be important to you at one point, way or other. So what we're going to do is we're going to go ahead and get started. And the first thing that I'm going to do now that we're into the webinar part is we're going to really take a deep dive into M&A terminology. The first thing that we're going to take a look at are deal structures and types. Now, obviously, with the M&A side, obviously in the title mergers and acquisitions, that gives you an idea about the types of deals. However, within each group, there are different types. For example, a merger, that's when two companies come together to form a new company. I remember back in the 90s that Chrysler merged with Daimler and created Daimler Chrysler. So, that's a pretty self-explanatory term. Acquisition is, when one company is going to purchase another. Now, one thing that we should look at, just because this is what may actually happen when, say, for example, a business is not able to really sell their business and they're just liquidating, is an asset purchase, which is what happens when you purchase the business assets as opposed to the business itself. This is something that if you're going to be working with me would not be a good situation just because of the fact that just selling off assets, that's not a good thing, especially if you want to get maximum value. What you do want is what we would label, say, a stock purchase, which is buying ownership shares of a company. These are the types of deals that, we would like to arrange, especially if you're going to be going on the M&A route and you're going to be working on a third-party sale. Horizontal mergers are where you have competitors in the same industry decide, okay, what we're going to do is we're going to form one company. If you remember that illustration from earlier, Daimler Chrysler, well, that is an excellent example of a horizontal merger where two car manufacturers decided what we're going to do is we're going to come together to form one company. A vertical merger is when it's a little different. It's like, say, for example, a car manufacturer decides what they're going to do is let's manufacture with a company that produces tires, or like say, or better yet, maybe let's have a merger with a company that's actually working to fabricate engine parts that we need. Basically, a vertical merger, essentially what it is it's two companies at different places in the supply chain that decide what we're going to do is we're going to merge to form one company that's going to really help us with our operations. A conglomerate merger is when you have two businesses that have unrelated entities they decide to merge. When I think of a conglomerate, I think of a business that I actually talked with years ago when I was working with a film company, and that's Ansa McCall, which, while they're headquartered in Trinidad and Tobago, they have business all over the world. And while they have logistics, they also have a lot of other companies within this conglomerate that basically function as one business, even though they're not at all related. In fact, they recently purchased a wine company, and wine and logistics really just they don't have anything in common other than the fact that it's the same company that owns them. Now, a leveraged buyout is when there's an acquisition that is used through creating significant borrowed funds. This can be a bit of a challenge just because the person who's buying is going to take on debt. And if you want to get an idea about what happens, well, Manchester United in the 2000s was actually purchased by the family that owns the Tampa Bay Buccaneers, the Glazer family. And in order to do that, they actually had to do this concept of a leveraged buyout. Well, because of all the debt that they took on, they needed to actually um, raise ticket prices and really just increase revenue in order to service all of the debt, which was not really met with satisfaction by fans at Old Trafford. A management buyout is when the company's management team decides that they want to purchase the business. This isn't this could be an ESOP, but ESOPs basically are when the employees own it, so it may not. So an ESOP might be a little bit bigger, but basically, with a management buyout is when, let's say, for example, people who are underneath you decide, hey, let's go ahead and buy out the business from you. And then a carve out strategy is when you decide, okay, what you're going to do is you're just going to sell one particular business unit. I remember a while back, Disney was talking about the potential of selling ABC just because of the fact that they were considering, liquidating and getting rid of some of their holdings. And in that case, ABC would be viewed as a carve out. If now, obviously, Disney still owns ABC, but I'm just using that again as an example. A roll up strategy is when you decide to acquire a bunch of smaller companies in the same industry, which, obviously on a larger scale, that's kind of what Disney did the last decade through purchasing entities such as Pixar, Lucasfilm, and then, even when they acquired ESPN and ABC. And while we may not look at them and think, okay, those are small companies, the reality is that's kind of what happened is there was a bit of a roll up strategy there where they were acquiring different studios. And this can be a strategy that can be very effective when it comes to trying to increase your overall revenue and really make yourself more attractive to a buyer by just buying like businesses and really rolling up other businesses within the industry with the goal of creating an entity that is going to be much more valuable. So that ends the deal structures and types section. Now what we're going to do is we're going to move on to the valuation and financial terms, which this is an important thing, especially if you work with me. You're going to want to be getting a chance to understand these right at the beginning because what my preference is to do is for us to get a valuation right at the beginning so we know the value of what we're dealing with. Enterprise value is what the total value of the company is, including debt. In other words, it's like, okay, this is this is what everything costs. Everything, absolutely put everything in. Now, EBITDA multiple is a common valuation metric, which with a lot of the businesses that I work with, my goal is if I'm going to take you on as a fractional client, is that you have about $1 million in EBITDA per year, just because of the fact that if you have that, that means we're going to be able to easily take it the investment banking route. If you don't, then most likely I would prefer, serving you through a fractional leadership roundtable. But the reality is that EBITDA multiple and really understanding how that works and why the 1 million benchmark is so crucial is something that I really would like to stress here. Now, discounted cash flow is a valuation is based on projected future cash flows. And on this point, what I should say is, with a lot of projections like this, it's important to remember that while these are valuations, later on we'll understand why the deal can actually get impacted, especially if these projections do not hold out. Um, the next one is comparable company analysis, where basically you're doing valuation using similar companies. Again, this is when a lot of the detailed industrial valuations are done. Well, in addition to looking at your benchmarks, we're also looking at what the rest of the industry looks like, specifically how similar companies have sold. just so that we can get an idea of what the actual value is. Um, Now, precedent transactions is a valuation based on similar past deals. And that's where we're, um, focusing, because obviously with a comparable company analysis, we're just looking at the entire industry. Whereas with these precedent transactions, we're looking at valuation that's actually based on just the deals and not, we're just focusing on the deals as opposed to the companies. Now, the earnout is something that's really important here just because of the fact that this is going to be something that, remember when I said about the cash flow, that valuation? Well, your earnout is actually going to be a contingent based payment that's based on future performance. So if the business is going to be performing well, you can expect to have a good earnout. If the business is not going to perform as well as possible, then, the earnout's going to be diminished. I know of some people who didn't get any earnout just because the business didn't hit the qualified benchmarks. So what's important is understanding, this concept and realizing that, when it comes to the sale, part of what you're going to get is going to be performance based, and it's going to be how well the business performs. Now, working capital adjustment is a post-closing true-up based on actual working capital. And what is and that's that's a little bit, I guess, for lack of a better word, when it comes to the well, we're this is something that we're just basically trying to look at and see, okay, how do things align as far as where things stand with working capital? Because again, with working capital, if you're buying a business that is somewhat limited for one reason or another, well, that's going to affect the valuation. Whereas if you have a good, healthy amount of working capital, then you're going to be in really great shape. I've had businesses that would like to have at least a year of cash reserves to cover all of expenses. I know some businesses might not be able to do that, but that's a good example of, one good thing to have in mind when it comes to preparing for this. Quality of earnings is basically an analysis of the sustainability and accuracy of earnings. In other words, we're just going to see how sustainable is this. And as you can imagine, as you're probably looking into this with these analyses, uh, businesses that are up and down year after year, and there's no consistent growth, they are not going to perform very well in this part. And this is where valuations are going to hurt substantially. And that this is an example of one of them, the quality of earnings. It's going to almost look, probably jokingly, look a bit more like a question mark, just because it's just all over the place. Now, normalized EBITDA is when we have adjusted earnings removing one-time items. This could happen. It could be a significant one-time purchase. And that's the challenge with using an example like this, is because there are so many different things that could be um, just classified as that. And basically, what we're doing is we're taking a look and going, okay, well, this was just a one-time purchase. It's not something that you go out every year or every quarter or even every month get. Since it's just one time, let's just adjust things accordingly. Now, add backs are non-recurring expenses that are added back. As you can see, there's a bit of a difference here, whereas the normalized EBITDA is basically removing one-time items. These add backs, they don't recur, but they may not just be one time. So obviously, normalized EBITDA, as when it comes to add backs, there are some things that would actually fall into these categories, but some won't. But really, at the end of the day, the goal here is to try to classify things and really help us in terms of making sure we're getting a really accurate value as far as what the value of this business is. Seller's discretionary earnings, which, this is a common metric for smaller businesses. It's basically, well, just what the title means. The discretionary earnings, what you're actually earning. So that ends the valuation and financial terms. And again, part of this, it might vary from business to business as far as which terms you're going to need. So that's why, you know, I'm not necessarily going to get into a whole lot of details. I mean, we'd obviously would discuss it if once we got the valuation. The next group is the deal process and documentation, and this is something that's really important to understand. The letter of intent is a non-binding outline of deal terms. In other words, it's somebody coming up to you saying, hey, we're interested in this business. It's not like we're selling. We're coming to buy this, but um, we're very interested. And this is kind of along the lines of what we're thinking right now. Due diligence, which is something that I actually aid in terms of making sure we get everything in place, is where we're doing a comprehensive investigation of the company. Everything from audited financials to documentation, insurance, benefits, a lot of these things, just making sure that everything is in order is key, just because, with due diligence, again, you're looking to make sure everything's fine. It's kind of like with a house inspection. If there's termite damage or if there's a cracked foundation, those are things that are deal breakers. Um, Now, the data room, which is basically a secure repository of company information for buyers, you know, this is going to look a little different for each company. I know I have software that I use, but it's on my end, and I'm actually not the one handling the data room. But again, this is kind of like the idea of where we're putting all the key information for so that it can be presented to buyers when necessary. The purchase agreement is the binding contract that is outlining all the deal terms. This is the big one, and it's really what's going to sign it and say, okay, these are the terms that we've agreed to. The representations and warranties are, if you're selling the business, these are your statements about the business. And what is in here? Well, it really depends on the sale and what what is necessary here. I mean, there's going to be some variation here, but obviously this is coming from the seller to the buyer. Indemnification is a protection against losses from breaches or undisclosed issues. I think most people are familiar from this with standard contracts. There's really nothing different from the M&A process. That's really kind of the way that uh, indemnification works across the board. Escrow, this is funds that are held back to cover potential closing cost claims. I'm sure if you have done had mortgages, you have escrow accounts, and you're fairly familiar with the way it works. It's pretty much the same here. Just instead of say selling a house, this time it's involving the sale of a business. Closing conditions are basically all the requirements that need to be met to close the deal. In other words, these are the things that, once we're getting close to it, it's like, okay, what do we need to get done so that way we can sign it? Though it's kind of like, the finish line. It's like, okay, what is it that we need to do to get across that finish line so we can get this deal done? Material adverse change or basically significant negative change that is going to be allowing a deal termination. This would be something, it could be due diligence. It could be a key person leaving and causing the value of the business to plummet and not recover. It's essentially it's something that's catastrophic. It could be almost viewed as a black swan, possibly, but really it's something that happens. It could be preventable. And I know of businesses that have actually lost um, substantial value because key people left, and it was entirely preventable. But unfortunately, they didn't ask key questions that they needed to. The confidentiality agreement is all otherwise known as NDA, a non-disclosure agreement. This is signed in order to protect all sensitive information. Um, and as you can imagine, if you're signing an NDA, that means you are obviously very serious about this. Obviously NDAs, it's pretty much the same as with other things. Basically, businesses will have you sign NDAs for other one reason or another. Essentially, what it's trying to do is just trying to protect something sensitive, which in this case is the company's information that we're trying to safeguard during the sale process. And then the exclusivity period is during the time where the seller can't negotiate with other buyers. This is kind of once we've gotten to the point where we've decided to settle on a specific buyer. Now, obviously, if that were to fall through, then okay, then we would exit that period. But it's almost like kind of like it's bigger than say a contingent offer with a house. With a contingent offer, it's like okay, um, things are there. It's if you were obviously were to come in with a much higher offer, a lot would depend on the business owner. But really, when it comes to it, that period with the exclusivity period is like such like okay, um, it's almost like for example when somebody's dating like an engagement period before they're married. Just it's like okay, they've committed, they haven't officially married yet, but they're viewing this as an exclusive relationship. Okay, so now that we're done with that process, let's take a look at some of the strategic and operational terms here. Synergies is value that's created by combining companies. Now, obviously, I know we talk about synergy in business, but here what it is we're looking at what is created by combining these companies. Most of the time, it's like, say, for example, cost savings, such as, okay, certain staff that were handling certain jobs. Well, we actually can reduce some of the staff just because it's duplicative. We don't need this overhead. Or it could be just because of the fact that it's complementary and we're saving time with things, okay, we're able to actually cut expenses. So really, those are just some examples, but essentially what it is it is the beneficial side effects, you might say, of this deal. Integration is basically the process of combining two companies post-acquisition. Now, this can include everything from creating a consolidated accounting process where you're basically trying to do bookkeeping for multiple organizations that are basically subsidiaries of a business, to just getting things tidied up operationally. Um, it just depends really on what needs to be integrated, but really that's what happens. Like once the sale is done, that's where the work needs to be occurring. Now, accretion and dilution is when the deal increases or um, decreases earnings per share. Um, again, this is going to be contingent on a lot of factors, and really, when it comes to the business world, there are a lot of things that could cause things to go up or down. And really understanding what these terms mean, usually it's going to have things to do with the economic environment in which you currently are in. Now, a strategic buyer is basically an acquirer that is seeking synergies and a strategic fit. In other words, they're looking for a specific business that is going to be, basically complementary to their current offerings. A financial buyer, which is usually a private equity firm, basically they'll purchase and they're focused on a financial return. I am not really a big fan of private equity companies, and it's because of the fact that they have a tendency of really putting almost an unhealthy emphasis on this. They will come in, they will try to optimize, maybe gut the business, reorganize it, with the whole goal of really just getting the maximum financial return, even if it's at the expense of what was actually a really good company. Now, a platform company, basically, they're an initial acquisition in a roll-up strategy. And in other words, it's like, okay, you have a roll-up strategy, kind of like what we talked about earlier. Well, you're the first one, and you're just number one in the process, just because you're the first one that we acquired. Now, an add-on acquisition are going to be subsequent acquisitions to a platform company. So these are going to be businesses that as you've bought, you've decided, okay, well, this is the first company. And just like, the idea with the platform is, okay, you're going to have stuff on it. Well, okay, as we have additional businesses, well, we're going to have these businesses add-ons now to this particular business. Now, one topic here, goodwill, it's basically the premium that's paid above book value of assets. I mean, obviously, I think we can think of different situations that this might happen. This is something that just knowing that that's the case, and I'm sure that there could be reasons for it, but really understanding that when this happens, when you're paying something above the value, that is what's labeled as, is there's actually goodwill happening. Now, this is a big thing that we work to mitigate, and that is the key person risk, and that is dependence on specific individuals. At the end of the day, you can work to minimize as much risk as possible, but the reality is every business, it is every business is going to have key people. Some might be a little bit more important than others. Obvious, if we had people who are non-essential personnel, the big question would be what in the world are they doing there? Because if they're not essential, then are why do we even have them? But the key person is when we have several important people and and really there are ways you can do this. You can obviously key man insurance. You can have really good deals. Obviously, one illustration I remember, um, a business actually lost about 30 million in value because they didn't tell their key people. They thought they were tied down, but when they heard that they were selling, they decided to leave. Well, obviously, transparency, and there are a lot of strategies that you can also go in terms of, key man, just tying them down, as well as maybe spreading around a little bit of what they do to kind of de-risk it, so that way that it's not so heavily dependent on a business. But really, that is a major risk that every business is going to have to address in some capacity, and that's key person risk. Another big one is customer concentration. If you have about 30 to say 40% of your income coming from one source, that is going to be a huge red flag. Just because that customer goes, well, there goes 40% of your business. And you can imagine that obviously having the largest customer, having as small of a share as possible is ideal. And that is something that really um, we should be aiming at. But the reality here is when it comes to customer concentration, one of the fastest ways to de-risk your business is to try to find ways to basically spread out the risk by, reducing your reliance on one source. And I've actually seen this play out in multiple times. And when that one source has dried up, it has been absolutely catastrophic. And in fact, I remember one organization, they pretty much closed their doors just because as soon as that source of income disappeared, they just couldn't function. Recurring revenue, and this has two big definitions, MRR and ARR, monthly recurring revenue and an annual recurring revenue. It's basically predictable, repeating income. For example, the subscription model, like you have a subscription to, say, Netflix, you're paying 10, 15, 20 bucks a month. Those types of subscriptions, which are monthly payments or even annual recurring revenue, if it's like one annual lump sum that you pay. In both of those cases, that's recurring revenue, and that's really highly sought after just because it's the type of revenue that's like, okay, it's bankable, it's coming. I mean, obviously, if somebody cancels and okay, you're out, but the reality is just the way that's set up is you're able to have a pretty good idea what's happening if you have a lot of your accounts set up for, either monthly or annual recurring revenue. So now that we're gone through those terms, let's talk a little bit about the deal terms and mechanisms. The first thing, purchase price. Well, duh. Basically, that's pretty obvious. That's the total consideration that is paid for the business. I mean, really not rocket science, but that's what purchase price is. Cash free and debt free is basically when we're looking at the enterprise value, and what we're trying to do is we're excluding cash and debt. In other words, we're excluding the liquid assets as well as we're withholding all of the liabilities. So that's another way to look at things. Just like, okay, how valuable is it with those two out of the picture? Just because they will, they can be fluid. In fact, that's why current assets and current liabilities have the term current in front of it, just because of the fact that they can be very, very fluid. They can increase substantially one month, they can decrease substantially the next month, they can steadily increase or decrease over time. Seller financing is when the seller decides that what they're going to do is they're going to provide a loan for a part of the purchase. Um, there are obviously situations that this might come up in. Um, Frankly, I wouldn't necessarily be a fan of this. In fact, like leverage buyouts, I'm not a big fan of, just because of the debt. And, it's, I prefer it to be nice and clean, but there are sometimes that, you just have to have this option, and this is the way you're going to make it work. Um, Rollover equity is when the seller decides they want to retain ownership stake in the combined entity. So, obviously, ownership stake, it could be, they're just going to be a minority owner. It's hard to say exactly what amount of ownership they're going to be, but what they've decided is they want to retain some ownership in what is coming out of this deal. Now, the holdback is a portion of the payment that is withheld for a specific period. Um, Again, there are definitely reasons you might want to do this, different strategies. And really, a lot of this, as far as like the reason why you're doing some of these things, it really just comes down to uh, strategic reasons. It could be from past experience. Really, this is where the benefit of having a M&A attorney come in. I am not one, and even though I am not really heavily involved in this, just because of what I do in terms of getting people ready for it and then guiding it through the process. That's why it's very important that I have a good understanding of these terms and how they work together. A non-compete agreement, that's something that, I mean, we've probably heard about it. Some of us have signed, but basically what it means is the seller agrees that they're not going to compete for a specified amount of time. In other words, as soon as you've sold the business, well, you have X amount of years before, if you wanted to buy or start another business, that you can actually get involved. It makes sense, just because, especially the fact that, okay, uh, do you really want to go up against, does this business really want to go up against somebody that is providing competition for them? And the answer would obviously be no. I mean, who actually does want to have competition in this sphere? Now, the transition services agreement, or this, where the seller provides services post closing. This is like, for example, a business where the owner has had high visibility. The buyer is like, well, for this transition, would you mind staying on for about a year, just having some visibility as we're transitioning in, to really kind of help all the clients get a sense that even though you're exiting, that things are going to remain pretty much the same. So it's a nice way of helping things that remain stable and during this transitional time period. Now, the employee agreement is basically terms for key employees staying post deal. This is something that really, really, really needs to be given some key consideration. And I think just outlining some of the things I've already said, it makes a lot of sense why you want to do that. So just to prevent problems down the road, you want to make sure that you can just keep everybody tied down. And this is basically in the best interest of the buyer and the seller, because again, if they leave, that could impact your earnout substantially. Okay, so now that we've looked at that, let's take a look at the players or the advisors in this. If you're the buy side advisor, that is the person who is representing the buyer in the transaction. And conversely, the sell side advisor is the person who's representing the seller, which is usually the investment banker or M&A advisor. For smaller transactions, it would be the business broker. Now, private equity or investment firms that are busy buying companies for returns, and there's a good chance that if you work with me, just because of the approach I take, we may do business with private equity, but just because of the process that the investment bank that I work with uses, there's a very good chance that you are going to not find yourself in too much trouble with these. These are probably going to be private equity firms which are better run, and they're not so focused on financial returns. And just because of the fact that they're going to actually have to invest more, there are a lot of private equity firms who are wanting to buy at a discount. Now, the search fund is an individual that's raising capital to acquire and operate a business. So again, this is something that's like, okay, I want to operate a business, but I need to raise capital. And that's where the search fund comes in. Now, the family office this is something I've worked with a lot of people who are in family offices. This is a wealth management firm for high net worth families. Um, they could be single family offices or multi-family offices. But what they're doing is they're managing wealth and, everything from buying companies to, investments. But really, these are potential buyers who would be really your ideal buyers, just because of the fact that they're uh, they're interested in long-term acquisitions and long-term holdings, and they're not really interested in gutting businesses. They want businesses that are well built. Now, the quality of earnings provider is just a really nice fancy term for the firm that is actually conducting financial due diligence. Again, a lot of these terms, as you can see, it's like basically it comes down to um, rather technical but rather straightforward explanations. Now, what we're going to look at here is in the final section is exit specific terms. Exit readiness. How ready is the business for sale? This is a big thing that my focus is on, because my goal is when it comes for us to get to the actual M&A transaction, starting with the investment banker, is for the business to have everything set from the due diligence, but also making sure all of our institutional memory is prepared. The business has been properly de-risked. We have the full C-suite team built out. In other words, everything is set so that business can be really successful for the long term. That is what my focus is when I'm working with businesses, is making sure that they are completely exit ready. Investment memorandum is basically the marketing document for potential buyers. Um, you know, I know that with the firm that I use, they refer to it as a prospectus, where it's actually a very thick document that they will send out, and it's going to have all of the information about the business. So that way, everybody who, once they've signed an LOI and they want more information, well, they're going to be getting something like this. The management presentation is basically going to be the seller's pitch to prospective buyers. This is going to differ from firm to firm. The firm that I like to partner with, what they will be doing is, while there is going to be some discussion with the buyers, this is going to be later in the process, after they've seen the information and after things have been whittled down. And when it's clear, it's like, okay, we're trying to see, okay, who is it that we that we like. Now, the auction process is basically competitive bidding, which I know that, again, the firm that I partner with, Vestacor, they tell people, if you want it, more, more, more. That is the most important thing. Just make sure you get more. A proprietary deal is one-on-one negotiation without auction. Obviously, this could be a bit dicey, just because of the fact that, if there's no auction, it's not going to drive up the bid. But nonetheless, this will happen, and I'm sure there are certain reasons why to do this. And there are pros, and like with everything here, there were pros and cons for doing it. Deal fatigue is, well, that makes sense. It's exhaustion from the lengthy transaction process. And this is something that could be very realistic, especially if we've had one or maybe even two buyers fall through. Uh, Deal fatigue can quickly set in. And then, really, and the final area, which is seller's remorse, is basically the emotional difficulty of letting go, which is really something that is a major problem. On this point, I'm going to kind of wrap things up. The reason why this is such a difficult and tricky part of the deal is that when it comes to seller's remorse, sellers, within months of this uh, uh, deal, sometimes you up to a year, they begin to regret it. And that's about 70% of people who exit. So this is why I'm such a firm believer in this process really having three people. Me as the fractional helping with the exit readiness, the M&A advisor who really everything that we discussed here is basically terminology from their perspective, and some of the terms I probably may not have explained it the way that they normally would, just because they obviously handle things a little bit deeper and more rigorously than I do. But then on this seller's remorse, it's because of the fact that this is where the wealth manager comes in. Now, obviously, the M&A advisor and I will be doing our best to help the business owner, but the reality is that this is where a wealth manager is who is going to be invaluable, just because they're going to sit down, talk with the business owner and say, this is what you need to do. You absolutely have got to make this happen. The reason why is because you need to figure out what you're going to do with your life. You need to figure out how we're going to plan as far as like everything from investments to what your fulfillment is. So if you have watched this and you are really interested in me coming to help you with the exit readiness and then jump into this process, make sure that you have a wealth manager who is going to be working with you, just because they need to make sure that you don't suffer from seller's remorse. Well, that was our webinar on M&A terms. I wanted to thank you all for joining. I know this was long. We covered a lot of material and really a lot of information here that I hope is helpful. And, if you have any questions or interest, then please reach out to me and I would love to talk with you at some point. Thank you all again for your time, and I hope you all have a wonderful rest of the day.